Welcome to Sawyer Silver Valut. Right now, as you are watching this, the gold market is doing something that has seasoned Wall Street analysts sitting up straight in their chairs, hedge fund managers refreshing their trading screens, and everyday investors asking one urgent question. Is this the moment I have been waiting for? Because, ladies and gentlemen, what we are witnessing in the global gold market today is not just a price move. It is not just a number on a chart. What is happening right now in the precious metals world is a financial earthquake, and the aftershocks are being felt from New York to London, from Shanghai to Dubai, from the vaults of central banks to the kitchen tables of working families trying to protect what they have earned. Gold is in the headlines, gold is in the conversation, and if you have any money at stake in this market, or if you are thinking about getting in, then you absolutely cannot afford to look away from your screen right now. Because in the next several minutes, we are going to break down exactly where gold stands today, what is moving the market, who is buying, who is watching, and where the world's top institutions believe this historic rally is ultimately headed. Stay right here. This is your financial briefing, and it starts right now. Let us get straight to the numbers, because that is what you came for. As of today, Tuesday, May 26th, 2026, the spot price of gold in the United States is trading at approximately $4,562.69 per troy ounce. That is up $53, or 1.18% on the session. In gram terms, that puts 24-karat gold at roughly $146.70 per gram. For 22-karat gold, the standard used in much of the world's jewelry, you are looking at approximately $134 per gram. And for 21-karat gold, the price comes in at roughly $127 per gram. These are the live market benchmarks that traders, bullion dealers, and institutional investors are working with right now as the global session progresses. Now, to truly understand what these numbers mean, you need to understand the story behind them. And what a story it is. Earlier this year, in January 2026, gold made history. On January 28th of this year, gold reached an all-time record high of $5,602 per troy ounce, a number that would have seemed almost unthinkable just a few years ago. That was a moment that sent shockwaves through every corner of the financial world. Banks revised their forecasts overnight. Central banks doubled down on their buying strategies, and retail investors who had been sitting on the sidelines suddenly rushed toward gold with an urgency rarely seen in any commodity market. Since that peak, gold has pulled back roughly 16%, and it is now trading in what analysts are calling a consolidation phase. But make no mistake, the structural bull market that drove gold to those historic highs is very much still intact. In fact, many of the world's most respected financial institutions are saying the correction we are seeing right now is not a warning sign. It is an opportunity. So what exactly is driving all of this? What forces are pushing and pulling on gold prices every single day? Let us walk through them clearly and carefully, because understanding these factors is what separates informed investors from those who simply react to headlines. The first and perhaps most dominant force right now is inflation. As of the latest Consumer Price Index data, inflation in the United States is running at 3.8%, nearly double the Federal Reserve's 2% target. Energy costs alone have surged 17.9% year over year. Real average hourly wages have turned negative for the first time since April 2023, which means American workers are effectively earning less in purchasing power than they were a year ago. When inflation is high and real wages are falling, gold becomes one of the most logical places for investors and institutions to park capital. It is a store of value that no government can print more of, and no central bank can devalue overnight. That dynamic is actively feeding demand for gold right now across every category of buyer. The second major driver is central bank demand, and here the numbers are staggering. According to the World Gold Council's Q1 2026 Gold Demand Trends Report, central banks around the world purchased a net 244 tons of gold in the first quarter of 2026 alone. That is a 3% increase year over year, and it marks the continuation of a multi-year trend that has seen central banks become the most consistent and aggressive buyers in the global gold market. Countries including Turkey, China, India, and several European nations have been systematically increasing their gold reserves as a hedge against currency risk, geopolitical instability, and the growing fragility of the global financial system. JP Morgan's metals strategy team projects that central bank purchases for the full year of 2026 will reach approximately 755 tons, still dramatically elevated compared to pre-2022 averages of 400 to 500 tons per year. This is not a short-term trend. This is a structural shift in how the world's monetary authorities view gold as a reserve asset. And it is not just central banks. Physical bar and coin demand surged 42% in Q1 2026, reaching 474 tons, the second highest quarterly total ever recorded in history. That means everyday investors, collectors, and retail buyers around the world are not backing away from gold even as prices remain historically elevated. They are stepping in. They are buying the dip. And that behavior is exactly what analysts look for when they want to confirm that a market has a durable floor, a level below which prices are unlikely to fall significantly because the demand simply does not let it. Now let us talk about what has been creating some pressure on gold prices over the past several weeks, because a complete picture requires honesty about the headwinds as well. The key short-term challenge for gold has been the Iran-related geopolitical situation and its effect on oil markets. For a period in recent weeks, diplomatic signals around a potential U.S.-Iran nuclear deal raised hopes that the Strait of Hormuz, one of the world's most critical oil shipping lanes, could reopen more freely. That prospect temporarily pushed oil prices down, which in turn eased inflation fears slightly and briefly reduced safe haven demand for gold. However, more recent reports have complicated that narrative significantly. Iran's supreme leader issued a directive indicating that the country's uranium stockpiles must remain on Iranian soil, directly contradicting earlier signals that had suggested a deal might be within reach. That development has reignited geopolitical uncertainty, and as of the most recent session, gold has bounced sharply, gaining more than 1% in a single trading day on Monday, May 25th. The geopolitical risk premium is back, and that is a key reason why today's price action is decisively to the upside. Let us also address the US dollar, because the relationship between the dollar and gold is one of the most fundamental dynamics in the entire financial world. When the US dollar is strong, gold tends to weaken, because gold is priced in dollars globally, meaning a stronger dollar makes gold more expensive for buyers in other currencies, reducing demand. Conversely, when the dollar softens, gold tends to rally. Right now, the dollar has softened noticeably as markets reassess the outlook for Federal Reserve policy. Expectations for interest rate cuts had been pushed back considerably earlier in the year because rising energy prices were keeping inflation stubbornly elevated. But with some of those geopolitical pressures easing, at least temporarily, and with U.S. economic data showing signs of softening consumer demand, traders are once again beginning to price in the possibility of rate cuts later in 2026. Lower interest rates are historically bullish for gold because they reduce the opportunity cost of holding a non-yielding asset like gold compared to interest-bearing assets like U.S. Treasury bonds. If rate cut expectations build through the summer, gold is likely to be one of the primary beneficiaries. The global gold market picture is equally important to understand. In China, the world's largest gold consumer, demand has remained robust despite elevated prices. Chinese investors, both institutional and retail, have been increasingly drawn to gold as domestic equity markets have remained volatile, and the yuan has faced depreciation pressure. In India, the world's second largest gold consumer, the government's record gold import duty hike has created some friction in the jewelry market, reshaping how physical gold flows into the country. However, investment demand in India has remained relatively resilient, with investors substituting jewelry purchases for gold coins and bars. In Europe, rising geopolitical anxiety and persistent concerns about sovereign debt levels have kept gold demand steady among both institutional and retail buyers. And in the Middle East, where gold has always held deep cultural and financial significance, the combination of regional instability and elevated oil revenues has kept demand firm. From a market forecast perspective, the consensus among major financial institutions is decidedly bullish. JP Morgan has projected that gold will reach $5,000 per ounce by the fourth quarter of 2026. RBC Capital Markets has taken an even more aggressive stance, raising its 2026 gold forecast to $5,723 per ounce and projecting $6,500 per ounce for 2027. Ventura, the brokerage firm, sees gold in a target range of $4,600 to $4,800 in the near term, with the long-term trend firmly upward. State Street Investment Management's May 2026 monthly gold monitor emphasizes that with global debt now approaching $348 trillion, U.S. net interest expense set to exceed $1 trillion, and defense budgets expanding globally, gold's role as a strategic reserve asset is likely to strengthen further, not weaken. The big picture, when you step back and look at it honestly, is this. Gold is in a structural bull market that has been running for several years, and the underlying forces driving that bull market, inflation, central bank buying, geopolitical instability, dollar uncertainty, and a loss of confidence in traditional financial systems, have not gone away. What we are experiencing right now at around $4,560 per ounce is a mid-cycle correction inside a much larger long-term upward trend. History shows us that these kinds of corrections, painful as they can feel in the moment, often turn out to be the last significant buying opportunities before the next leg higher. The investors and institutions that bought gold during past corrections did not regret it. And the question every viewer watching this right now needs to ask themselves is whether they want to be ahead of this trend or behind it. Gold is not just a commodity. It is not just a shiny metal. It is a 5,000-year-old form of money that has outlasted every empire, every currency collapse, every financial crisis, and every attempt by governments and central banks to replace it with something easier to control. In a world where inflation is running hot, where geopolitical tensions are reshaping global alliances, where central banks are quietly but aggressively stockpiling physical gold, and where the purchasing power of paper currencies is being eroded year after year, gold is doing exactly what it has always done. It is preserving wealth. It is maintaining its purchasing power. And for those who pay attention to the signals, it is telling a very clear story about where we are in the global economic cycle. Today's numbers are your starting point. $4,562.69 per troy ounce, $146.70 per gram for 24-karat gold. A market that is up on the day, up significantly on the year, and backed by some of the most powerful structural tailwinds in modern financial history. Whether you are a seasoned investor, a first-time buyer, or simply someone trying to understand what is happening in the world economy, gold is telling you something important today. And now you know exactly what that is. For more videos like this, subscribe to our channel, Sawyer Silver Valut.